Hey everybody, welcome to another Bitcoin Intelligence Show. Today is Wednesday, June 25th, and today I have two friends and co-authors of the Bitcoin Intelligence Report with me. We have Crypto Wizard as always, and Reno is also joining us. Hopefully, he will keep joining us in the future sessions to talk about the piece that he writes for the report about monetary mechanics. Hey guys, how are you? Welcome.
Hey, pleasure to be here, guys.
Yeah, pleasure to be with you guys.
Awesome. So as always, this midweek update is designed to review our Monday report and maybe add some ideas or update you guys about some new pieces of information that has emerged since then. So we published another, 17th edition of the BI report on Monday afternoon. And that was focused on, as always, again, macroeconomics, on-chain, and money. And we basically looked at a couple of the important developments. Let's see how I can put ourselves in the side. We don't have, we only have two cameras here. How can we add another one for Wizard? Maybe Wizard can stay out.
No worries, go ahead.
I messed up your layout, guys.
You have an avatar.
No worries.
Yeah. But Reno, if you know how to quickly bring his avatar, that's fine. But I'll try to manage. Anyways, so let's look at the first thing. Very, very excited. Oops. You see, that's what I'm saying. It begins automatically. One of the big changes in the platform is we kind of moved things around to make it easier for you guys to follow. And on the new dashboard, first off, if you're not a Smart Vault customer, you don't see that immediately. But you will mostly see the Bitcoin intelligence related stuff. By the way, check this out. Our Smart Vault is one of the best ways to self-custody Bitcoin. But nevertheless, when you look at the dashboard, you see on the left, you see the latest reports. This is the last one. And then you also easily see the other ones. Using some of the feedback you guys gave us, we also add the dates and report number. Report number is wrong. It's including some of the older articles. We'll fix that. But on the right, we also have the videos, latest videos. Some of them, well, all of the Bitcoin intelligence shows like today will be there, but sometimes also unique ones. This is like the one I recorded after FOMC will also be available. So you can easily see it. Also, we have some of the charts that might be interesting added to the end of the page, but you can also always click and go to specific areas. Okay, with that, let us just look at the latest report. This report is titled Seller Exhaustion. And the general sense we got from the market was, we have had quite a bit of correction, and seems the market seems to be in a place where there's a lot of strong support, and the sellers are also beginning to capitulate, especially short-term sellers are selling at a loss. So it was possible that the sellers are getting exhausted. But again, the report also goes way beyond on-chain and looks at many different ideas. All right, so let's just take a quick look. Our macro section looks at two things: Iran-Israel war. Our main message here was that this can only impact the markets through the oil link, and oil damage like closing the Straits of Hormuz was determined in our analysis to be very unlikely. And so, yeah, full closure is unlikely, but there could be some increase in costs and so on. But we just got a ceasefire right after that, so probably much of the risks are gone, and that's probably why the markets have recovered well. Then we got the FOMC, which had a confidence to wait decision. This is so funny. Both I and Renault commented on it, but I liked what Renault had written here. Confidence to wait is one of the, what was it, like the dumbest, no, not dumbest, the funniest commentary on monetary policy. So they are basically trying to appear in control while they are not, and it's very clear that they have no idea what they want to do. They say we are data dependent, but at the same time the data shows inflation is going down, labor market is weakening, but then they throw out that data and look at a hypothetical effect of tariffs, which actually could not happen. There's a lot of reasons, and we actually do believe that tariffs will not be inflationary. But they choose to focus on that, and the only way I can interpret that is this is a subjective decision to just not cut rates yet, and you can speculate why, but it just doesn't make sense. It's not data dependent. Then we have our on-chain section. I'll let Wizard talk about it, and then we have monetary mechanics section where Renault discusses the treasuries and the Fed and liquidity and short-term issuance and the some of the changes in regulations regarding the banks. All right. Before we move on, I also want to mention whether you're actually getting good information from these reports. It's very important for us to match what we have analyzed with reality. So sometimes we go look back and see if what we said was right. Here I came across, actually, I noticed looking at some of the oldest reports that we had a very good call actually lately. You can go back to our previous reports. On May 19th, we titled the report, "I need to catch my breath," meaning essentially we had realized that the market needs to chop for a while. Or essentially what we write is, "For now, optimism reigns." This is when the price was about 110 or around that. But we anticipate a few weeks of weakness. This is some characteristic of our report. We sometimes, if we do have enough data and conviction, we do make a call, and we are directional. We do take the risk, right? So, and many times actually this year, some of these high stake takes turned out to be right. So it's a good information for us to know that, okay, the data we're tracking actually works, and it's good for you to know that what you're reading actually is based on good signals. All right, with that, on the macro side, we reviewed the war. I'm highlighting our analysis that said the drop below 100 was overreacting. Apparently, the market was overly fearful of it, which happened, I think, on Sunday. Then the market recovered, and you know everything about the war, and the price of oil is crashing. This is also important. In the last report, we had mentioned that even though all this huge rise in price of oil has happened, but it's important to realize that there's a background, which is energy and inflation. Inflation is going down, economies is slowing down, and because of that, there is not a lot of demand for energy. So even though there's a short-term spike, overall, the trend is down. So I think we mentioned that energy prices, energy risk may be temporary. With the current information, Iran is unlikely to escalate into blocking the straits, as that would trigger U.S. intervention. Markets may be overpricing the risk of prolonged energy disruption. And exactly what we're seeing. I haven't looked at the latest number, but I'm expecting oil prices to keep going down the rest of the year. And then we also, again, had FOMC. We talked about that. I won't repeat myself. And Trump keeps attacking Powell. Today, Renault, I saw a lot of people on Twitter attacking Powell as well. Has he made any comments or something? I haven't followed that piece today. But
I didn't see specifically on Powell, but I'm seeing movements within the Fed with Bauman and also Walzer is his name, the other one from the Fed, giving more and more hints that they probably should start cutting in July. And so yeah, it's just part of the agenda where it forces to have any kind of interactions with the media. Not only the FOMC meetings, but now we have those intermediate meetings that just I mean, it's just signals and a lot of stuff just to move the market.
Waller's actually in one of the previous reports we mentioned. Waller's is the one that was very clear that even if tariffs cause inflation, in his analysis, and I think this is correct, this will be a like one-off rise in prices, and then we don't have a continuous raising of prices, right? It's one off and stays there, right? Because of that reason, his analysis was that he was willing, this is exactly his word, I'm willing to look past that, meaning we keep cutting. But again, Jerome might have other things in mind. He has his this whole fight with Trump. Maybe he's holding out on cuts to kind of keep his legacy or stick it to Trump. His legacy apparently is a Volcker personality. So he maybe overemphasizes on reducing inflation and whatnot, but they should have, I think, cut, and they didn't. And it's very suspicious. So, and Trump is not mincing words. All right, so I'll stop there. I'll let Wizard talk about on-chain data. And I wish I knew how to change the camera quickly, but while I figure that out, I'll let Wizard cover his piece.
Perfect. Thank you, Sina. So I'm going to get to the on-chain quickly. And what we want to talk about today using on-chain is in an isolated order. I'm trying to look at the data and discarding what was happening in macro and say what would be the anticipation about the immediate term movement in the market if we were just looking at the on-chain data. So it would be to the reader's decision to choose giving more weight to the macro, which I would actually these days, because the headline, it's a headline driven market. You could see if you put the breaking news on the Bitcoin price chart, you would see the inflection points having a very strong confluence with what was the news in that day. So in such a market, on-chain would help you to understand what phase you are, but it is really hard to speculate about the next move. So that's the theme this week when we go to the on-chain. First of all, we want to go back and see what happened when market broke below 100,000 and why it got a very strong support, or I would say seller exhaustion around 98. If you look at it, first of all, the cost basis of the short-term holder or the buyers over the last 6 months, which is mostly the top buyers, was around $98,000. So when price has been above that 98,000 for a while, that means new buyers bought it, but the cost basis is 98. When the profit they're sitting on is shrinking and it's almost close to the break even, especially if it's been after a while of trading above the short-term holder cost basis, that's going to create some sort of confidence in the market. So the first break down towards the short-term cost basis, usually people get some sense of like, okay, this is just a short-time dip. That's why you see the sellers that are fearful about the further correction start to sell, but as soon as we're close to the break-even point, they stop selling because they say, okay, the profit is over. This is a temporary correction, and we're going to go up again. That's why you see there's a high chance around the cost basis of 98,000 short-term holder, you see some support. If you put the supply of the short-term holder in the different buckets based on their cost basis, you could see around 98 or 100,000, a big chunk of the short-term holders, a big supply belonging to the short-term holders were in loss. Around 43% of the short-term holder were in loss, but that was a significant support level when we look at it. If we look at different supply zones for short-term holder, the next one would have been 90 to 92, but we have not broke below that price, and 98, which is the cost basis of short-term holder, played a strong role in picking the market low. But beyond that, if we look at other metrics, especially the reaction by the short-term holders to that price, which is the SOPAR, that was interesting as well. SOPAR is showing the cost, the ratio between the market price to the cost basis of all these new investors, specifically because here we are looking at the SOPR of short-term holder. That one briefly broke below 1. That means for a short amount of time when market was around 100,000, breaking below 100,000 briefly, the SOPR was below 1. That means a small amount of loss was realized as well. But when we look at the extreme lows, that was not a very significant capitulation by short-term holder. It was possibly a small portion of the recent buyers sold at break-even and a small loss, and that's why the market stopped the selling pressure, because that break-even point is really significant. In bear market cases, when we see this, the price breaks below and stabilize. By stabilize, we mean like 1 week, 10 days price trading below the short-term holder. That's where we can call for a mid-term to long-term bear market. What happened in April 2024? What happened in around February 2025? So that's why 98,000, as I talked about it again and again, is a very decisive price level. We don't know when we're going to break below it, but we have to look at the headlines. We have to look at the macro and look at what's going to happen to the rates in summer. All that factor is going to affect it. But if anything driving the price below that 98, and we stabilize below for a week, we can see the confidence among these short-term holders can actually vanish, and we see some sort of sell pressure by these disappointed recent buyers. And if you look at the supply heat map, which is the chart that I'm going to wrap up my part with, is if you look at the supply that moved at top in Q1 2025, we have a very concentrated supply between 93,000 to around 100,000. That means a large portion of supply have moved in that range. And if you look at the example that we experienced in 2024, yes, going through a sideways market, chopping through the same range over a long time, it could be positive because people are accumulating and they are hoping for higher prices, and that's going to be a support level in long term. But at the same time, if price get stabilized below this range or stay in this range and go downside slowly, time is going to be not a friend of the bulls anymore. So what we would like to see, if we want to just to speculate about another leg up in this market, is we see market gets like deviated from the upper range of this thick supply range, which is around 92 to 100, 103,000. So we need price get away from this 103 in a meaningful way, as we discussed 2 weeks ago, around 115. When price breaks above 115, some structure like this one is going to happen when market is way above this recent buyers. They feel confidence, they have higher confidence in the market, and having a little bit demand is going to push the price way higher. But as far as we are in this sideways market and we are sometimes testing the 98 or short-term holder cost basis, there is always a chance that market get spooked by a macro negative event and break below. So the range that I would look for is 98, around 100,000. If stabilizing below, I would call for a mid-term bear market. If it break above of around 13, 14 and strongly go to 115, which is around 1 standard deviation above the 98,000 for short-term holder, then I would call, hey, there is a high chance if the activity in the Onchain metrics goes up, there's a high chance that we see a rally like we saw in October or November 2024. So that is the end conclusion in Onchain. 98 range, 98 and around 115, 111 to 115 is the range that I will look. And any break above or break below this range would be confirmation of bear market or bull market in mid-term to long term.
Yeah. So basically, there's a lot of liquidity in that region. If the liquidity can't even keep the price and it falls below it, then it's a really bad sign. Fortunately, it looks like we are going the other direction, and the seller exhaustion is working for now. And macro essentially, so we have a confluence. A macro risk went away, and there was a lot of capitulation by short-termers as well. So I think they together helped return the market to the highs. But again,
and if you go back and look at beyond these metrics, which we didn't use this in this article because it would be too long, most of those capitulation happened when we hit 98 was in futures market. The spot market has already been slowing down since like early May. That's why we are calling for a fragile market. Even though it is positive, it's fragile. We need a quick catalyst from macro side to break to 115. Longer we stay in this range, more frustrated this new investor going to be, and more prone to react to negative macros in long term. So we need the catalyst as soon as possible, and then we can call for, hey, market is going to go leg up if we break above like 1 standard deviation above the short-term holder cost base.
Yeah. If you go up a little bit to the SOPR chart,
Yeah.
yeah, this is very interesting. Like as you said, if the market stays in a frustrating period for a long time, people suddenly lose it. If you look at last year, you see that like from November 2024 to May, no, so not last year. The last time we were observing a push, yes. So the price goes up, people sell in, take profits, and then kind of market slows down. But if the price slows down for a long time, suddenly you see a lot of people taking losses. Exactly where
Yeah.
your mouse is. Like a little bit after that, suddenly people are selling at a
Yeah.
loss, and it's kind of like they have like some period of tolerance. But if the market really doesn't move up or begins a slow bleed, they lose confidence after that point. I think the
Yeah.
same pattern happened last year after 7 months of bleeding. People
Yeah.
started selling heavily at a loss, and that was actually exactly when we bottomed.
Yeah. So it's going to be up to Renault to tell us what is the macro environment in midterm. I know it's going to be hard call given there's war or maybe not. There's a lot of shit going on, so I really like to understand what Renault says about macro.
For sure, for sure. So basically, on a macro side, I believe we started at the huge attack on the U.S. So the U.S. were not the hot trade anymore. Everybody should get out of the United States as soon as possible. Have your dollars elsewhere. Then he went to Europe, which reflected on the DXY, as we can see here. So right now it's actually even lower. I think we are on a 97. And this just fuels the narrative after the whole Moody's downgrade. So, okay, the US is not to be trusted. Bonds is like a hot potato. But then we forget about monetary mechanics, how it actually works and how important they are truly. So I try to convey to people that the bond market is not really about the United States, but it's something about the whole world. So every part of the bond yield curve tells something different. And in my opinion, is really all about collateral. It's all about the short end of the curve, which will be pretty much be provided. So right now we have this relief from the dollar, even though most people think that the dollar is actually weak on a way that is collapsing because people maybe China is trying to move towards another currency or whatever, but it's actually the opposite. I would be way more concerned if we got a DXY of 115 or 120, because that really means that the rest of the world is not able to get enough dollars to serve their current debt. So right now we have this relief of liquidity going all over the place. We see emerging markets. We've seen many ways to make money all around the world, and it was actually pretty good for Bitcoin as well. But now what I think we're going towards is maybe a little bit of a reversal. For sure, it could get a little lower. You see, for example, I'm also Brazilian, and I take care. I have a lot of. I track this a lot at what happens against the Brazilian real, and it's as low as as recent past. We were over 6.2 for the dollar, and now we are at 5.49, which is pretty strong. And people think this will be this way forever. So especially if you are watching from an emerging market, I would be a little more careful, because the pendulum could swing the other way and create problems into those countries. However, worldwide liquidity, in my opinion, especially if we talk about T-bills, T-bill issuance, from what's happening right now. So this is just the narrative on the dollar is unpopular right now, right? So I think this will come to an end because of global debt. Debt is just going higher and higher all over the world, and it's even more outside the United States than inside of the United States. And we need to serve those debts, and they are denominated in dollars. So we need those dollars. And now we see signs of emerging markets underperforming U.S. stocks. So now we see money coming back home to the United States. As love it or hate it, that's exactly how it works. So it's just coming back home. And I believe this will create some asymmetries depending on where you live. But what happens in the United States affects the whole world, because the US wants to it's just becoming way too attractive. So if you see real interest rates, of course, Brazil is pretty high, Russia is pretty high, but do you actually trust those bonds? The US, the yield curve in the US and real interest rates for something that has zero credit risk just becomes way too appealing for money to go back to America. And this will create, and also based on the administration right now, Trump literally said, look, we're going to issue short-term, 3-month, 6-month T-bills, which are the pristine collateral that the market needs.
This is huge, because
huge.
Yellen left them with a lot of short-term paper, and the worry was that they have to then, because when you issue short-term, you're supporting the market a lot, and of course that makes sense. Right before election, they wanted to do all they can to keep the markets afloat, so they overly issued short-term. But the worry was that now the new administration has to balance it out and issue long-term, and that would be negative. But it's very clear that they have this strategy to keep issuing short-term.
Exactly. And this is exactly the most pristine collateral, especially on the run collateral, which was pretty fresh, or freshly minted, so to speak, if we talk on crypto terms. So, and this is exactly what the market needs. And this is also the reason why the Fed doesn't know what to do, because this here is monetary policy. It's made by the Treasury. It's not being made by the Fed anymore, because they are the ones issuing the debt and actually financializing the whole market, because they know that the more stable we get collateral to be, if it doesn't move too much, and we can see the yield curve, there's a lot of demand for the shorter end of the curve. This just creates leverage, and more leverage means more credit, it's more liquidity, and that pumps the market. So that I believe this is going to be a huge tailwind that's going to help a lot driving that liquidity. But of course, it does not happen right away. It has some lagging effect. But I would be just cautious on, if you are, for example, if you buy Bitcoin on a currency that is not the US dollar, or especially if it's an emerging market, for example, like Brazil, Indonesia, all of these countries, you can be caught by surprise depending on how quick things go, because most central banks are cutting rates. The Fed is just stuck. We're data dependent. We are confident to wait, which is the most amazing thing I've ever heard. So they don't know what to do. They're just waiting on maybe a report like ours.
I'm so confident that I can't do anything. I just sit tight.
It's absolutely amazing to see, and the more stuck they get into a higher interest rate compared to every other central bank that is cutting, can create a little bit of a friction and make U.S. bonds be way too so that magnetic field can be too attractive for capital to flow into the United States. And of course, then it goes to stocks, bonds. That's why I'm bullish as ever, even on U.S. Markets right now. Maybe we shouldn't be, but that's how the liquidity works, which is absolutely crazy. Even though we had a so many messages on so many tweets about World War III are almost happening, or the canal closing, and it doesn't change. It's incredible because fiscal is dominant, and even if we have problems with liquidity, Trump's not really gonna let it, and Besson just. I've never seen Besson so many times on the media as I don't recall Yellen being so often on the media talking about the yield curve and the 10-year yield. So they're really looking towards that. And otherwise, some great macro scenarios as well would be on the regulation part, which is very exciting for this meme, that nothing stops this train, because even though we have problems yet on the balance sheet capacity of banks to actually absorb treasuries when needed, creating a little bit of a problem on swap spreads being negative. We may be going the right direction. Still, we still need to wait and see, because it doesn't necessarily mean it's going to be exactly what the market needs. But Besson really seems to know it, and Bauman as well on her Fed speech that she did recently. So they are aware of it. They really want banks to be exposed more and not be too tight, like JP Morgan, for example. They cannot be exposed at all. This is why maybe when you have a JP Morgan Chase account and you try to deal with crypto, they close your account. It's because they really do not want to get exposed at all, so that they don't have any problems with regulation, because they are on the front line on getting those treasuries. So this is going to be really, really interesting to see. I think it's a huge boom, and bullish as ever.
One question: can you clarify a little bit how exactly mechanically this works? If they enable banks, maybe dial down the reserve requirements. How exactly that supports Bitcoin, for example? Can you make that link more clear?
Yes. So it's the mechanic is repo. So it's all about repo markets. So on a repurchasing agreement, you need to have those bonds available and not move too much, so that you're able to leverage on them, and that's how you create credit. The big problem we have right now is that banks in many places, they are not able to do very trivial arbitrage plays where they could just lend money to the Fed and buy those bonds and absorb them and park them into the Fed for free, for basically free money. They're not able to do that because they do not have enough space on their balance sheet, because through the SLR, which is the supplementary leverage ratio, if you absorb, even if it's as safe as it can be, because it's treasuries, there's zero risk. If you go under a certain level, you really cannot do that. So they're not able to absorb even though it's safe, and that creates confusion in the markets, because they think that U.S. bonds are not becoming safe, and that creates some pressure upwards on interest rates, which is artificial, because it's not a problem on the fundamentals of the bonds, regardless of what we hear. It's they need it, but they cannot perform it. But once we have more space, even though I don't believe SLR is the only problem, RWA, for example, risk-weighted assets, could be also even more important than SLR right now, but it's still going the right direction. And even though we have those constraints, banks also adapt through shadow banking, for example, Cayman Islands and other places, to do that job that they're not able to do under the Fed regulatory framework. So, but again, they're limited. It doesn't mean that they're just free to do whatever they want. This is why you see so many small places like Cayman Islands or the UK being the biggest buyers of treasuries, or because not only stable coins, but also the shadow banking system that allows everything to happen, commerce to happen, and credit right now. So we have to be fortunately or unfortunately thankful that this exists, because it's a way that they were able to survive under that framework that changed since 2008. So we have liquidity, even though it's restrained. But can you imagine if we make some changes, or maybe even Basel III have a little bit of more room to work? That could be amazing for sure.
So yeah, liquidity is created when, for example, bonds are issued. They can act as collateral. They enter the repo market, but then after that, you need players, big players like banks, to be able to arbitrage and allow different markets to link together nicely, so liquidity can flow within these like a pipe, like water going through the pipe. Exactly why people call it plumbing, right? So, but when banks are limited because of regulation, that system doesn't work well, and say hedge funds or other kinds of investors can't raise the funds they need, which will then be should be allocated to stocks and other things and Bitcoin. So when people cannot lever up and investors are tied, then you have problems. And in worst cases, they actually have to sell things, right? If there's big problems, then they have to sell to raise some cash to get out of positions because they have liquidity issues. And then in those cases, Bitcoin is the first thing that gets sold. So this is all great. So we are getting improvements in the bond market. We're getting improvements in the banking sector. Another piece of information is the tax bill. Again, there seems to be nothing stopping it, so it's pretty much going as planned. By the end of summer, we probably have a lot more clarity, and if it gets enacted, which in all likelihood it will, then we also have a lot of spending from the government. So we have fiscal support as well. Combine all that, what do you get? A huge positive liquidity regime. Yeah,
Exactly.
so that's why essentially in our playbook, the longer run is very bullish. But if you read the full report, there is also some cautionary notes about shorter term, possible hiccups. In the past few issues, we have also talked about TGA being a short-term problem. But nevertheless, if you're someone who focuses on the longer run, things are getting very well aligned. Earlier this year, we had all sorts of problems with tariffs and trade war and all sorts of uncertainty. This is all coming to an end, and a new regime is starting. So we will definitely be there to analyze it from the on-chain perspective and from the macro and money perspectives. Thanks a lot for being with us and trusting us with the most precious asset you have, which is your attention. And we will keep tracking the markets and bringing to you the best analysis we can. All right. Thanks a lot, everyone, for the great input. Thank you, Wizard. Thank you, Renaud. And we'll see you guys next week.
Thank you, guys. Nice to see you.
Thanks.